Hello, this is Larry McMillan with a market update on Monday, January 18th. Today's a holiday, Martin Luther King Day, so market's not open, but I'm putting out this update prior to tomorrow's opening. Um, Last week the market was down, and it seems to me that people jumped on the bearish bandwagon pretty quickly. I'm not sure that's the right thing to be doing because we don't really have that many confirmed sell signals yet, anyways. Let's just review things. The S&P is still in an uptrend. It's still above its rising 20-day moving average. All of its longer-term moving averages are rising. Roughly speaking, there's support at 37.50, 36.50, and 35.50. Actually, a little bit lower than that on most of those, but at least until some of those are broken, I would not consider shorting the market. We're looking at the 36.30 level as being extremely important, though. If that is broken, then you could probably short the market. Um, the put call ratios are meandering sideways. They've been doing that for a while now. And even on Friday, put call ratios were still pretty low. The CBOE equity only put call ratio was a 45. Breadth has been a little bit stronger, but it was, of course, weak on Friday with the market down. So another day of heavily negative breadth is probably going to cause some sell signals from our breadth oscillators. But that hasn't happened. So just keep an eye on things. If you see like 1,000 declines or so by the end of the day, then you could probably assume that those breadth oscillators have rolled over to sell signals. um, we look at also the cumulative breadth and cumulative volume breadth made a new all-time high for 8 trading days in a row, culminating with last Thursday. That's very positive, and that generally predicts that S&P will go to a new high. So it's a little farther away now than it was on Thursday, but it, still not that far away. But it still would be would be indicated by the cumulative volume breadth. The new highs versus new lows. New highs have dropped back a little bit, but new lows are still basically non-existent. So that indicator remains positive as well. In volatility, we did have the realized volatility sell signal last week, and that's still in effect. But implied volatility is still staying fairly bullish. VIX is still operating off that VIX spike peak buy signal of January 5th, and it's also still below its declining 200-day moving average. A thing that you also want to keep your eye on is the VIX futures. If the front month, which is still January, but as of Wednesday will then become February, if that rises above the second month, then that's a pretty negative sign for the market. And usually, if that happens in the state where the market is very overbought but rolling over to weakness, it in the past has been a very strong sell signal. In any case, we are coming into a slightly negative seasonal pattern between January 20th and 28th, and then that's followed by a seasonal bullish pattern. So right now, things are still not setting up strongly on the sell side, but we are beginning to see a few things that might chip away at the bullish case. But the main bullish case right now is the strength of the S&P chart. And unless it breaks support, you need to remain bullish with the majority of your positions. So thanks for listening, and visit our website. We're still offering discounts on our newsletters, which wrapped up a very terrific year in 2020, and also our CTA managed accounts were up strongly on the year as well. So good luck and good trading.